Hey everybody, welcome to my channel. My name is Justin. Thank you so much for joining me today. I'm happy you're here. Have you asked any of these following questions? How does the stock market work? What makes stocks go up and down? Are there other resources or tools I could use out there that tells me if a stock market is overvalued or undervalued? Are there other resources or tools out there that could show me when to get into a stock or out of a stock or just in and out of the market in general? Well, I'm going to answer all these questions today for you, so stay tuned. Hey, welcome back everybody. Thank you for joining me. My goal here is to help you achieve financial freedom by investing in your future and investing in yourself. So I'm going to answer all those questions that I asked before. Guys, this is a very in-depth video. In fact, I'm going to get into some more advanced charting here in this video. It's a foundational video where it's going to keep building and building and building on top of each other. So guys, I definitely encourage you guys to stick around so you get the whole picture. In fact, it took me over 10 hours to put this together. So I really enjoyed it. Hope you did too. So let's get right into it. So before we jump right into the charts, let's kind of talk about, where we're at right now in the market, because I want to use this market as an example when we look at the charts, kind of determine where we're at type of a deal. So if you look at this chart right here, this is the VOO, Vanguard S&P 500 ETF. So this ETF basically mirrors the S&P 500. So you can see back in March, obviously the whole Rona situation that happened, we just saw the whole market just collapse by about 40% plus during that month. And then you've seen us just slowly, kind of gradually build up all the way getting back to where we're at right now in November. And I drew that line all the way across the graph, and you can see we are flat. We are basically flat from where we ended in March and we're at right now. So obviously a lot has happened, but it doesn't reflect what's happened or what's going on right now in the economy, right? So we still have high unemployment. If you're in the service industry at all, especially like restaurants, I mean, that segment is still hurting bad. So the economy is not churning like it was in March. So the market right now is not reflecting the economy, and that's really important to know. But we need to talk about why the stock market has come back so quickly and what's the catalyst for that. And so it's really important to know that the top 1% of income earners in the United States can, own 50% of the total stock market that's out there. So 1% owns half of the stock market. That's huge. So when they say the rich keep getting richer, poor keep getting poorer, I mean, this is a really good illustration that the rich keep getting richer, right? And so they're obviously putting money back in the stock market. So they pulled a bunch out in March, and then they've been gradually putting it back in the stock market to where we get right now. So why are they doing that? It doesn't make any sense on the surface, right? Well, the reason why they're doing that is really twofold. So the first is they don't really have a good place to put their money right now that makes any sense like they did before. So maybe they had money in a savings account or a CD or something, just earning some interest. Right now, Powell and the Federal Reserve and the government, they've basically reduced the interest rates so much. Basically, Federal Reserve reduced the rates so much that they're basically zero right now. So these wealthy people that know money better than anyone else, especially their money, they're not going to put in their savings account. They're not putting in the bank. So it makes sense for them to put in the stock market or the real estate market. If you are a fan of Jeremy from Financial Education like I am, he's had some videos even recently where he's talking about buying real estate. He bought a home in like Las Vegas, a home in Arizona, and these are big dollar value homes, $1 million plus homes. And of course he puts a lot of money in the stock market. So he's a good example of the top 1% and what they're doing right now, right? And then the second factor why these wealthy people are pumping money back in the stock market is the value of the dollar is going down. And it's going down day by day. So the value of the dollar back in March is not the same value it is today. It's less. And that is going to continue, I think, to happen out into the future. And this has been going on for a long time. It's just been on our radar this year because of the whole, stimulus. So we're going to continue seeing these wealthy people keep pushing money into the market until they have a better place to put it at. So the first chart that we're going to look at is the Schiller PE. And basically, Robert Schiller is the one who developed this. He's won all kinds of Nobel Prizes that are out there. Smart man. And so what he did is he was able to figure out how to create a graph or a chart that shows us what the price per earnings of the total stock market is, right? And a lot of people, when they're looking at stocks, are looking at the stock PE. Well, this is basically the P of the entire stock market. And historically, we've seen it around 15 to 16. So logically, anything under this 15, 16 mark is probably undervalued as a whole in the market. And then anything over, 16 would be considered overvalue. Now, I'm about to shock you guys because there's only been 3 times in history, 3 times where the Schiller PE has been over 30. And the first time was back in 1920s, 1930s-ish era. The Great Recession happened. Obviously, the stock market absolutely crashed. The whole economy, it's called the Great Recession for a reason. And it took a while for the economy to get back to where it was. But scary, scary, scary times, right? The second time was in the year 2000 when we had the huge tech bubble. So people were pumping money into these tech stocks like no other, just inflated the stock market, and then it just came crashing down on itself. And then now, this is the third time, guys. So this is really, really important to keep in the back of your mind right now, because what the Schiller P is telling us is that the market's it's basically overvalued twice as much as what it should be versus what companies are earning right now. So red flags should be going off right now. So the second chart we can look at, and this is the chart that Warren Buffett always talks about, and it's the Wilshire GDP. And if you ever want to look it up, it's Fred Wilshire GDP. So don't forget the Fred in the front of it. You might get something else. But this basically tells you, or it's a ratio that looks at the total GDP of the United States. So that's the total revenue of the United States, and it's comparing it against the valuation of the stock market. So typically, we find that the stock market is about 80% value, or what we consider normal, 80% value of GDP. Well, what's been happening is that it's been going up, and right now we're at over 200%. 200%. It's circled right there. So what this graph is telling us is that we're 2.5 times overvalued than we should be right now. So more red flags going off. And if you follow Warren Buffett at all, you know that he really hasn't been unleashing his huge pile of cash this year. In fact, he's been selling a lot of stocks. He has bought some, but overall he really hasn't been doing anything. And he really looks closely at this graph and believes in it, and it's a good indicator of when the market is. So we've just looked at two graphs that are giving red flags all over the place that this market is overvalued. And so when I came in to the stock market, I really didn't understand why stocks go up and down. Like, for example, Apple, right? And say it's worth $100 today. I don't know if it is or not, but let's say it is $100. And all of a sudden the next week it went up to $105. I didn't understand why it went up. It just seemed magical, right? Or it went down to $95. Well, why did it go down $95? What happened? So it really goes back to supply and demand. So as money is pumped into a stock is going to go up. The demand is increasing. If money is being pulled out of the stock, the demand is decreasing, and so is the price. It's really as simple as that. So we've already talked about the top 1% of income earners own half of the stock out there, right? What we have not talked about is who controls the money that's out there. So this is extremely important. So who controls the money out there? So it's not you and I. Most likely you're a small investor like me, and we are just a blip on the radar. We're probably not even a blip. I don't even know what we are. We're so tiny you can't even see us, right? So if we're investing in an Apple stock and we have $100,000 in it, and we pull it out one day, the stock is not going to move. We pump $100,000 in that stock, it's not going to move. We really don't have enough impact. We don't have enough money flow to impact that stock. Now, who does? Well, it's the institutional fund managers. That's who controls 80% of the total funds in the market. So who are these institutional fund managers? So think about your 401k at work. Most likely you probably have like 15 funds or something like that you get to choose from. That fund is actively managed, ran by people. And sometimes they'll have one, manager. Sometimes they'll have several, which is just absolutely insane. But it's actively managed by these institutional managers. You might hear them as called like mutual fund managers or hedge fund managers, but these are the people that I'm referring to. And there's hundreds of different mutual funds that are out there, but they control 80% of the market. In fact, they are the market. They are Mr. Market. So you bet when they start pulling money out of stocks, they drastically impact the price of the stock. It goes down. If they're pulling it out, it's going up if they're putting money into it. So a huge advantage that we have as small investors is that we are so much more nimble than what they are. We can pull money out, we can put money in, we can do it in a matter of seconds. They can't do that. They manage billions and billions and billions of dollars. So they don't have the luxury of just pulling, money out of out of stocks, because as they pull money out of stocks, they're tanking that stock because they're pulling so much out. So they have to do it in chunks. And so it takes them weeks and weeks to get out of a stock because they don't want else it crashes. They're pulling money out of it and it's worth almost nothing. It's counterintuitive what they're trying to do. So wouldn't it be really, really, really nice to have a tool or resource that tells us when these fund managers are getting in and out of stocks? Because as a little investor like us, we can just follow them. When they're getting out, we could get out of our stocks and we can do it much quicker than they can. So we're going to take a lot less loss than what they will. Or if we can see that they're, going into the stock market, we can follow them as well. So this can be, and so these three charts I'm going to show you next illustrate that, and they help us. They're a great resource in determining when, these big hedge fund managers are getting in and out of the stocks. And each one of these graphs represents something different, but as a whole, they represent so much more to us. So the first one I want to show you is called the moving average chart. In fact, I'm going to show you the first two charts up here on the screen. So the first one is the moving average. And all that is you're just seeing the total stock price. This is the S&P 500 that you see here. But the total stock price, and then you see the line that's kind of closely following it. That's a 10-day average that I put in this chart. And then the second chart that you're seeing here is the MACD. And the MACD is actually very similar to the third chart I'm going to show you, and it's just a momentum indicator. So it's just showing us how the stock is being affected by money being pushed or pulled out of the stock. So these are stock graphs that we can see with money managers putting in and then taking it out as well. And so before I move on to the next chart, it's really important if we go to the next chart, if you guys see what I have circled here on these graphs, and I actually have obviously two circles on each graph, and what I'm trying to do is illustrate two different periods in time. So the first circle that you see on the left, that's back in March. So that was right when the whole Rona situation happened and we had everything collapse in the market at that time. That second circle you see off to the right is our current situation where we're at right now, right? And so what we're looking for is having these lines cross, and maybe I'll make another video going more in depth on why they're crossing and what each line represents and all that, but this video is going to be long enough. I'm not going to go into that. So just know that what we're looking for is when the lines cross, and we want them, if they're crossing on each graph at the exact same time, that's a big indication for us to do something. So you can see on the MACD, you can see on the moving average, on the left side and on the right side, they have crossed at the exact same point of time. And then the charts are going the opposite direction. So you can see in March, they're starting to go down, and then you can see the one in November is actually going up. So now I'm going to move to the next chart. This is the Scholastic. It's also a momentum indicator telling us when fund managers are getting in and out of the stock market or a particular stock in general. And so again, I have two areas that are circled, or the areas have crossed. So again, the left one it was the time in March. and then the third is currently here in November. And so what I want to key on is the one in March. That's telling us to get out of the stock market at the same time. It's all three charts saying, hey, they're pulling money out, get out right now. And that's what happened. The stock market just absolutely tanked at that time, right? And then if you look at the circle off to the right, which is the current period of time, the last time they crossed was I think it was like November 3rd, November 4th, somewhere right around there. And that's when these fund managers, when investors are pumping money into these fund managers, and the fund managers have to do something with it, and they're buying stocks at that time. So what that's telling us currently right now is that money is being still pushed into the market. It's not being pulled out. So right now it's saying don't do anything. Money's still being pumped in. But keep in mind what the charts that we looked at before for the Schiller PE and the Wilshire GDP is warning, stock market's overvalued, right? And I had a video last week. At the end of the video, I talked about Apple stock specifically. I charted out and showed you guys, hey, it's doubled in valuation, but it hasn't doubled and actually what it's worth. And in fact, it's worth half of, you're paying double of what you were a year ago. So it's overvalued by twice what it is right now. So Apple is a good example of a stock that's just so overvalued right now. And that's the largest stock in the stock market. So guys, let's just have a quick overview. So we talked about the P Schiller ratio. It's screaming that we're overvalued. Wilshire GDP is screaming that we're overvalued. We've looked at the MACD, we looked at the moving average, we looked at the Scholastic. That all right now is telling us that money's being pumped in. We shouldn't be doing anything. Don't worry about getting out right now. And I guess a quick thing. And so guys, I want to point out that these charts that I've showed you with the moving average and the MACD and then also the Scholastic, depending on what brokerage firm you're using, these should be available to you. So the ones I showed you today are in Charles Schwab. That's what I use for my main accounts. I also have Thinkorswim through TD Ameritrade. That's actually the best software that I've seen so far as far as the best resource. And they do a really good job actually having arrows in. They point when stuff is going up and down and that sort of thing. So it's more interactive. But if you have like Fidelity and some of the other big ones, you should have access to these charts. And so guys, these are really good tools to even look at individual stocks and potentially getting in and out of them just in general. I usually don't use it as individual stocks. I know people do. I tend to look at it as an overall market when I need to get in and out and that sort of thing. So guys, let's kind of talk about, an overview of what we've learned today on this video. And then I want to kind of give you what I'm planning to do over the next month, 2 months, that sort of thing. Where things are in the current market. So we learned that the Schiller PE is saying that the current market is overvalued. Typically Schiller PE is around 15, 16. Right now we're pushing over 30, which is only third time in history. Warning. Then we look at the Wilshire GDP, which it compares the total GDP or the revenue for the economy comparing against the total stock market valuation. And right now it's showing that we're at over 200% when typically the average over the last 140 years has been around 80%. So again, looks like we're really overvalued currently. And then I showed you those three charts, moving average, the MACD, I showed you the Scholastic, which could be really good indicators on when to get out or in a market. You can also look at them for individual stocks as well. So those are all the different things that we've learned today. So let me give you my personal opinion on what I'm going to do. How I look at everything right now is I think the market, and I think investors right now are just in euphoria. It's just past even rational anything right now. So because it's not rational, the stock market could literally just drop tomorrow 10%. or it could go up 10%. We've literally saw that in the last week. I had one day, and I posted a video up, my stock market accounts went up 12% one day. Here's a snapshot of my stock market account from yesterday, and I was up 2.6%. I'm up almost 95% this year. And so it's crazy. I can't even gauge this market right now. So I'm leaning to be conservative. I don't like risk at this point. Right now I'm in 17% cash. My goal is to build my cash position up right now. Looking at the Wilshire GDP, looking at the Schiller PE, it's just time for me to get more and more into cash at this point. So what that means is I'm going to start trimming my tech positions first. So I have 3 tech companies that I own right now, and one of those is Facebook. In fact, it's my second biggest position currently. I'm going to be trading back that. I'm not going to get rid of the full thing. I think when the stock market does crash, the FANG stocks in particular are going to get hammered, absolutely hammered. And if you're in that tech arena at all, it's going to be bad. It's going to be so ugly. And we've kind of seen that shift here recently, right, out of tech and into value stocks, right? You've seen, stock market's up, but the NASDAQ is just heavily down, which is a lot of the tech stocks. And so when this crash happens, I expect that to accelerate even further. So, I need to minimize my risk. So I'm going to be trimming down my Facebook stock. I did start buying a tech stock about a month ago because I thought it was a really good value. I stopped buying that. I'm not buying anymore. I'm not selling it. I got it at a good price. It's just going to sit. My third tech stock, I'm selling completely. It's probably going to be slowly over the next month, but I'm going to get rid of that. Then I'll be evaluating some other stocks I have that are service-oriented, trimming those back or even selling those at this point to build my cash position again up to 30%. I'm also going to have another video out in the future that's going to talk about another stock that I am looking to buy to hedge myself against this market. And there's a couple of possibilities I could go with, so I don't want to talk about it today because I don't know which way I'm going to go yet on it, but I certainly will come with a video on that. So that will be a 5% position in my portfolio eventually. So guys, that's kind of where I think the market is, what I'm planning to do. It's gonna be crazy over the next year. But I'm hoping you guys got this, enjoyed this video, got something out. If you did, please like, please subscribe. I put a lot of effort into this video. Just try to educate you guys. I love doing this. Please join the family and subscribe. Love to have you here. I hope you guys take care and God bless.